Welcome back to Mastering MHA MBA. This is Chapter 10 of Managerial Accounting, Part 2 of 4, based on Managerial Accounting by Datar and Rajan from Pearson. Part 1 priced quality failure in dollars. This part is about finding it and fixing it, the non-financial measures, the 3 diagnostic tools, and the decision math for quality improvements. Here is an uncomfortable story. Toyota is the company business schools use to teach quality. In December 2023, investigators found its subsidiary Daihatsu had been faking safety tests for over 30 years. No cost of quality report caught it, because the rot was cultural, not financial. By the end of this part, you will know the measures that do catch it and what they cost when nobody looks. Financial measures look backward. Non-financial measures move first, so managers track them alongside the dollars. From the customer's perspective, the classics are the number of complaints, returns, market share trends, repeat purchase rates, on-time delivery, and the percentage of defective units that actually reach customers. None of these is in dollars, but each one is a leading indicator of where external failure costs will show up next quarter. The internal business process perspective looks inside the operation. Defect rates at each station, first pass yield, downtime, rework hours, and the share of employees actually trained in quality methods. Watch that last one. It is a prevention measure, and it is exactly the kind of number that flatlines years before a scandal becomes public. Now the 3 diagnostic tools. First, the control chart. You plot a process measure over time, say the defect rate on a production line, and draw bands at plus or minus 2 or 3 standard deviations from the mean. Points inside the bands are probably random noise. Leave the process alone. A point outside the bands or a drifting trend is a signal worth investigating. The chart keeps managers from overreacting to noise and underreacting to real shifts. Second, the Pareto diagram. Take every observed failure, sort the causes from most frequent to least, and draw the bar chart. Almost always, a handful of causes explain the great majority of failures. That tells you where to aim. You do not fix quality everywhere at once. You attack the tallest bar first. Third, the cause and effect diagram, nicknamed the Fishbone. The spine is the failure you're trying to explain, usually the tallest Pareto bar. The big bones are the usual suspect families: people, machines, materials, and methods. You keep asking why down each bone until you reach a root cause specific enough to act on. Together, the 3 tools form a pipeline. Detect with control charts, prioritize with Pareto, diagnose with the Fishbone. Once you know the root cause, the fix becomes an ordinary relevant cost decision. On one side, the incremental cost of the improvement: redesign, training, new equipment, more inspection. On the other, the failure costs you avoid, including the opportunity cost of sales you would have lost. If avoided costs exceed the spend, do it. The trap is forgetting the opportunity costs, which, as Part 1 showed, are the biggest and least visible piece. So which wins, the dollar report or the dashboards? Neither alone. COQ speaks the one language every executive understands and makes trade-offs explicit, but it lags and it hides causes. Non-financial measures are fast, specific, and actionable on the shop floor, but they cannot tell you whether a problem is worth fixing. Strong companies run both and evaluate managers on both. Every tool in this part assumes one thing: that the measurements are honest. Here is what happened recently inside the most famous quality culture on earth when they were not. December 2023. An independent committee found Toyota subsidiary Daihatsu had committed 174 certification test irregularities across 64 models, with some misconduct dating back to 1989. Daihatsu halted shipment of every model it had developed worldwide, a total internal failure cost. The committee's diagnosis reads like a fishbone exercise: impossible schedules and a culture where the front line could not ask for help. The appraisal data everyone trusted was fiction, so every chart built on it was fiction too. 6 months later, the parent company itself admitted submitting faulty pedestrian safety data and using modified test vehicles in crash tests. Toyota idled 2 assembly lines, producing about 130,000 vehicles a year, and Chairman Akio Toyoda apologized publicly, saying the company neglected the certification process. To be fair, Toyota maintained the cars themselves met legal safety standards. The failure was in the testing process, not necessarily the product. But that is precisely the lesson. Appraisal shortcuts under deadline pressure turn into production stoppages, even at the company that wrote the playbook. That closes the quality half of the chapter. The next question is quantity. How much inventory should you hold? When should you reorder? And what did a pandemic, a blocked canal, and a chip shortage do to 40 years of textbook advice? Part 3 is the economic order quantity model and the real world that stress tested it. See you there.